Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome. This is the Wealth Without Wall Street podcast. Your host, Joey, the Italian Stallion Murray, joined as always by Russ, the Idea Guy Morgan. Russ, every day's Christmas, but especially the last 3 days of last week. We're at the Infinite Banking Practitioners Think Tank.
Wow. Whenever you get to have Christmas in February, you know you're living right. It was good. It was awesome to be around 150 of our closest friends, if you can say that. It's people that are doing the things that we're teaching you on this podcast. It's the people who are teaching us. We love learning from each other. And anytime you get to spend 3 days with brilliant people, you've got to come back fired up.
Absolutely. And the conversations that we got to have, either in the meetings, outside of the meetings, that's the kind of things that we need to share on this podcast. That was the whole reason we started the podcast.
Yeah. The podcast was meant to be a weekly conversation because we were having, people come in our office giving us ideas that we would then turn around and share for maybe the next week or two. But if you didn't meet us in the next 10 days, you probably didn't get to hear it. It's the same thing that happens with the think tank, right? Is that we get to hear, 10, 15 presenters sharing just unbelievable content, how they're changing people's lives, how the people are able to actually stop trading time for money by using these life insurance contracts. But unless you go, you don't get to hear it.
Yeah. So today is all about sharing some of those conversations we had with some of the greatest minds in the infinite banking community. And I have a really kind of a soft spot in my heart for the think tank, right?
Yeah, because somebody who thought enough of you took you, didn't they?
That's right. My mentor and coach took me 5 years ago to this think tank, and it was at that event, hearing some of the same types of stories we're going to hear today, that literally prompted me to say, wait a minute, what am I doing? I need to be impacting people's lives just like these guys are. I'm going to give up my career to do this full time.
And man, I am so grateful that you did. I would not be able to share this podcast room with anyone else other than you, Stallion. So, that was providential that God brought you into that think tank because, man, this is awesome. I know, this is just my moment. I know a lot of times on this podcast, I take time to kick you right square in the midsection. But bro, I am so pleased that you're working with me and helping our clients because you went to that think tank, you got inspired. And going forward, by the way, I want to throw this out there. If you're a client and you would like to come to the think tank, which won't be until February of next year, I want to give you an open opportunity to reach out to us and we'll figure out a way if we can't squeeze you in.
Man, that's huge. Yeah, this will absolutely change your life. But Let's go ahead and get into this. Now, who is it that we're interviewing today?
Well, we're interviewing lots of people. I can't remember all their names because I'll forget one and they'll be mad at me. But we've got at least 6, maybe 7 of our friends that we had over one night last week as we were doing kind of a pre-party to the Infinite Banking Think Tank. And we were asking them questions about some things that we thought maybe you'd want to know about.
Yeah. What if you could go back now that you know what you know and redo the first policy that you ever took out, what would you do differently? And number 2, what's something that's unique, if you will, the uniquest.
Uniquest.
Can I say uniquest?
No, that's not a word.
Okay.
Most unique, maybe.
The uniquest thing that you or one of your clients has used a policy for.
He never listens to me. You guys hear this, right? You're listening. You're like, Joey, that's not a word. It's not like strategery. Right?
Exactly.
Uniqueness or whatever you just said. But yes, we did ask those 2 questions. You're going to get to hear from people who have been practicing, and you're going to get to hear just the passion that they have behind the scenes, right? Because obviously we're all passionate about helping you, but how are they using this? How are they actually eating their own cooking? And what were some of the things that they would do differently?
Have you ever had the thought, I really am not saving enough for the future? And at the same time, you're sitting down to write an enormous check to the IRS every single year for $100,000, $250,000, $500,000 in taxes? Guess what? We just found the money that you should be saving, and it's been under your nose the entire time. Go to freetaxwebinar.wealthwithoutwallstreet.com and learn how the wealthy are paying less in taxes. You can implement these strategies so that the next check you write will be to your financial future and not to the IRS.
From Alberta, Canada, we've got Richard Canfield.
Because he can field our questions on this podcast.
That's what I've been told. These guys said that they're professional podcasters.
If anybody can field our questions, Richard can field them.
It's me.
Yes. All right, Richard, we've got a question that we need help with. And that question is, if you could go back to when you first started your insurance policy, how many years ago has that been?
Well, I'm literally days away, I think, from rolling over several dividend party anniversary dates on like 4 policies.
Okay.
So, because I backdated a bunch of them. So I guess one of them, probably the first one's going to be about 9 years. It'll be
9 years ago.
9 years, yeah.
All right. So 9 years ago, you bought your first life insurance policy.
Yes, sir.
Tell me, if you could go back into time, you could get in Michael J. Fox's DeLorean.
Yep.
Go back into the past. I don't know why they called it Back to the Future. But you go back into the past and you could do one thing over again. What would that one thing be?
Well, I mean, I'd probably wear different clothes than he did getting into the car. But
bring a flux capacitor.
I would definitely make sure to like have a spare flux capacitor. Otherwise,
of course.
Like, I mean, come on, who knows what's going to happen? You're going back in time, dude. I mean, really, seriously.
Seriously.
But for me, if I was going to do things all over again, one of the first things I would like, if I would have had more clarity of the topic at the time, other than just, really having an entry level knowledge of Nelson's book, I would have made the policy bigger. Or had I had someone that was me sitting there saying, hey, Richard, really, there's a way that you could do this and do more. This is why you should be considering doing that, and explain the benefits of it to me. That would have been tremendous, because, here I am 9 years later. What would I have more of? What would that have been able to allow me to do more of over that period of time? Because I could see the bigger picture, and being able to stretch the imagination enough. Now, Nelson says that this is an exercise in imagination. So if I had the ability to stretch that imagination more because someone could show it to me, absolutely, I would have, if I could have seen it for what it is, I would have gotten a bigger policy.
Love that response. All right. Second question, Stallion.
All right. So, Richard, we know you are changing people's lives in Canada every day.
I do what I can.
Sharing this, and we're grateful for your continued support in that area and doing that. Tell us, what is the most unique or interesting thing that you have seen a client use their policy for? Or maybe it's yourself. So something that they've used the policy for.
Well, I mean, so I'll go with the first thing that jumps into my mind. And so one of my clients, an earlier client, they're engineering clients, are amazing, wonderful people. Actually, literally, he's coming up on a milestone anniversary here for his policy. Like literally, I just got a statement on it like yesterday. They actually did a loan to a family member for purchasing a car, and they wrote up a loan document and everything there, and they collected principal and interest payments back on that loan. Meanwhile, policy continued to do what it was going to do. Everything's rocking and rolling. They get the advantage of the increase in death benefit, all the advantages that they have. Plus, they were able to help someone, which they wanted to do. It solved the cash flow need for that individual. It was really a true win-win scenario.
Yeah.
Now, it was earlier on, so maybe they didn't understand how all the security aspect of things worked around, but everything all worked out fine. They made a great level of interest on the deal. The gentleman wasn't able to qualify for the loan for the car anyway. He needed it. All the buttons kind of came together to make sense, right? So that was something that happened earlier on for them, and fantastic experience.
Welcome into the studio, Miss Winnie Lau from Alberta, Canada.
I'm so excited to be here. It's not very often I get to sit in like a true podcast studio here in the Wealth Without Wall Street. This is amazing.
It's a little bit, it's like, is it overwhelming? Would you say it's like all incoming?
I'm awestruck.
Awestruck. Wow. Write that word down as something nobody's ever said in here. Awestruck.
Well, we're going to get some different vocabulary
maybe,
because we're getting our Canadian friends with
That's right.
us today. So this is awesome. All right. So winning, we have a question for you. We actually have two questions.
Two questions.
But
right.
one
Not at
question,
the same time.
Not at the same time. We won't do that. One of the things that I think the person listening to you right now would want to know, since you've got a lot of experience. By the way, how much experience? How long have you been doing infinite banking personally? When did you buy your first life insurance policy?
In I think it's September of 2011.
2011.
Yeah.
Okay.
Okay, going on 8 years almost.
Yeah. So 7.5 years, right? Something like that. If you could go back and do it differently, knowing what you know now, since you've been teaching people, and there's some things you probably learned that you just didn't learn at that point in time, what would that one thing be that you would do differently?
So the very first policy that I actually set up was actually on my daughter, who was 11 at the time. So she's actually 19 and a half already. And so what I would do.
Okay, hold on. Before I start, why on your daughter, not on you?
Because she didn't have a life policy, and I already did, even though it was a term policy at the time. But because my daughter wasn't insured yet and she was 11, I thought, in our industry, in order to even get started, you have to be insurable. So I wanted to protect her insurability.
That's interesting.
I love that. All right, so she's 11. You're buying an insurance policy on her. Okay, go ahead.
Yeah. And so I'm really glad that I did that because, as parents, we like to groom them and hope that they always make good choices. However, her being 18, 19, they're bound to do some things that could possibly make them uninsurable.
Right.
So I'm really glad that I did. Without mentioning any specifics, I'm glad I didn't wait till she was, 18 or 19. And so with that, for a child's policy, the one that I set her up with, you can actually put flexible guaranteed insurability on there. So it's you can actually lock in future insurability amounts.
Sure.
And just me being green to setting up policies, one of the things that I did was I spread it out over 18, 21, age 25, 35. And what I did was I ended up setting it up at $25,000 at age 18 that she can convert.
Okay.
Instead of maximizing it, the most amount that I could have put for her to convert at age 18 was $250,000.
Oh wow!
And I chose $25,000 for some odd reason.
What did you choose it because it was cheaper?
I don't think it was the thing of
money. Did you think, well, will she need that amount of coverage? What is it that made you go $25,000?
Maybe I don't really recall actually as to why I chose $25,000 at that point. But now that I'm at that point and she just turned 19, it's why didn't I just choose $250,000 to start? Because insurance is cheaper.
Yeah.
When they're younger.
And you'd been able to do more. See, here's the thing though. I would say the first policies I set up for my children, I didn't add that guaranteed insurability rider to that. So I didn't have it. So at least you had that part going for you. Yeah. I mean, that's a good second question, Stallion.
That's awesome. Yeah. Thank you for sharing that. So as you are teaching people all across Canada right now, you're giving them the true way to financial freedom, which I'm so grateful to have you as a part of the movement doing that. What is some really cool, unique, different thing you've heard either a client do or you yourself do with your policy or with their policy?
Yeah, so just sticking in line with the story, this is on my daughter, because she moved out at age 18. So although I didn't choose the $250,000, to convert right away, what I did do is because I'm helping her to manage her cash flow properly, and if I'm going to leave this legacy behind for her, I'm going to ensure that I help to guide her along so that she has the financial stewardship, so that when I do go on, that she's going to be able to handle the cash flow in an appropriate manner. So she got her very first policy that she owns it. She bought it. So that $25,000 flexible guaranteed insured value, she actually took it over and she owns it. That's her very first policy.
Nice.
Yeah.
So she's paying for that with her own cash.
Her own cash. Yep.
Very cool.
Get them started young. I love it.
Yep.
Well, that you have done an awesome thing for her, not only insuring her life, hopefully she will always be insurable, but also at the same time giving her something that she can take ownership of. And that's going to be like, that's just an encouragement factor. That's something that's hers, and she'll hold on to that for life, and it'll be a great reminder and a great tool. So very cool. Great. Awesome job, Mom. Thank you for coming on the podcast.
Thank you for having me.
Folks, we have Brent Kessler in the bullpen today.
All the way from Daytona Beach, Florida, right?
That's right.
Man, we're so glad to have you.
Glad to be here, guys. Thank you for inviting me.
Yeah.
This has been an awesome evening, learning a lot of stuff.
Awesome.
Well, it's amazing.
Good fellowship.
Yeah, it's amazing
Good
when
networking.
you get this many people in a room that are used to talking, that we actually have people that are listening. I could hear there was some listening going out there because I didn't hear every voice.
How did you hear listening, Russ?
Because not every voice was talking, Joey.
Oh, okay.
That's how. All right.
I'm not going to call you out on that. Okay.
You're not?
No.
Were you going to cut that part out so that people won't know that you didn't do what you said you did? Or did you didn't?
All right, Brent, you know we have two questions for you.
All right.
The first being, you have come a long way since the first time you started a policy on yourself.
All right.
Knowing what you know now, what would you do differently about that policy?
Well, back when I first started, actually, it was back in 2006 was the very first time that I heard about this concept.
Yeah.
And I thought, man, that looks really good. That looks really cool. But it just looks too good to be true.
Sure.
Right?
I've never heard that, by the way.
And absolutely, that was me. I was sitting in the chair and I was there and I was like, man, that looks cool, but it just looks too good to be true. I was actually at a chiropractic conference because, as you know, I'm a chiropractor, right? So anyway, I was at this conference and I heard this message, and that was back in 2006. And after I left that conference, I had the book, right? The R. Nelson Nash book, Becoming Your Own Banker. I bought the book, took it home, put it on the bookshelf. Didn't do anything with it.
Yeah.
Go back to another chiropractic conference almost 2 years later, at the end of 2007, I would say. And about 10 or 12 of my colleagues are there with me at that conference, and they're just ranting and raving about how they're paying off their debt, how they're keeping control of their money, how they're not having to do any harder work, right? How they are, not having to take any risk. All they've done is they've done this one thing called the infinite banking concept, and their financial life was just changing. So I went home to my wife and I said, honey, there's got to be something to this. There's no way 10 or 12 of my colleagues are lying to me.
Right.
Possibly a couple of them, but not 10 or 12, right?
Right.
So I told her, I said, we got to start implementing this into our life. And at that time, I remember it because we added up all the debts and everything that we had. It was $984,711 in debt that we owed to third-party creditors.
Could we just round that up? Could we just call it $1 million?
Almost $1 million. So I told her, I said, we're going to start this process and we're going to start our first policy with $2,000 a month.
Okay.
Now, that conversation didn't go real well with my wife. It's very analytical, detailed. She's a nuclear engineer by trade, right? Every I's dotted, every T's crossed. As a matter of fact, I thought our next stop was going to be at the attorney's office talking about a divorce.
Right. She's like, where's this $2,000 coming from?
Yeah, where's the $2,000 coming from? But I knew we had to start doing something different. And, like she has through our whole life, she stuck beside me and she said, all right, honey, we're going to do, what you say. You are the leader of the family and we're going to do it. So to make a long story short, we started our first policy. And probably less than 6 months after that, we started our second one. So probably the thing I would have done differently, knowing what I knew then,
I would have started earlier, obviously, when I first heard about it.
The 2 years, yeah.
Yeah. Okay. So because here's what happened. Because I waited 2 years to start, okay? So hypothetically, like, let's just say I had 50 years of life left. Well, now I waited 2 years of life, or I waited to start 2 years, right? So now I'm starting 2 years later. Well, I never have to give up year 1 and 2. So the 2 years that I now have to give up are year 49 and 50, which are the most efficient years of the policy. So can you imagine how much money I cheated my family out of with cash value growth? Because I'm never going to see year 49 and 50 in the cash value or the death benefit number, right? Because I waited 2 years. So I would say not to have to overanalyze and have to have every detail in order to start. You just got to get around the campfire, drink some of the Kool-Aid, and just get this stuff in you, because it is the real deal. And you have to start. You have to start somewhere. Even if it's the lowest amount possible, you've got to get in the pool if you're going to learn how to swim.
I have a question for you, Brent. You brought up how you had round up to $1 million in debt and you got out of it. Okay. If I'm hearing this for the first time, I want to know how long and what in the world did you do differently? Because you got into the debt and now you dug yourself out. Most people never see that.
Right.
How did that change for you?
Well, it changed because I started paying myself first.
Okay.
See, the thing we've been taught, or basically have been told, we've been told to pay ourselves first. It goes in one ear and out the other. Do we ever do it? No, we never pay ourselves first. Here's what you do. Every time that a paycheck comes in or you get money, however you make your money, the thing you do with that money is you take it and you put it into the conventional bank, okay? The conventional bank of Alabama, that's where we're at today. Come to my town, the conventional bank of Florida. And the thing you do with that money is you pay everybody else first. You pay the car people, the house people, the student loan people, the grocery people, the electric people. You pay for the college or for the kids' soccer practice, basketball practice, food, entertainment, travel, and you hope there's money left over for you. You have to start paying yourself first. And the definition of paying yourself first is putting your money into a whole life policy in a mutual company that pays dividends, that's structured for just the banking concept, that it's designed and structured. Not any life insurance agent can say, oh yeah, I read Nelson Nash's book. I know who Nelson Nash is. I can design you a policy like that. Well, if that's what they tell you, ask them, why haven't they already told you how to do it if they know how to do it, right? Yeah. People don't understand how to do this. So you have to have a specific person that knows and understands this concept that's going to design and develop your policy to maximize the infinite banking concept.
So, Brent, you said you paid yourself first. What exactly did you do, and how long did it take you to get out of debt?
I paid myself first by putting money into the policy, paying premium.
All right.
Premium's a payment, right? That's what we think of a premium. Whenever we pay premium into a life insurance policy, it is a payment. I get it. But in your mindset, you have to think of it as a deposit and not a payment. Okay. It is a payment, but you've got to think of it as a deposit. Right. Because if it's going into an account that you control, is it treated more like a payment or deposit?
Right, more like a deposit.
And so tell me what word you like better, payment or deposit?
Deposit.
Have you ever made too many deposits in your bank account?
No.
Never. So you got to think of it as a deposit, right?
All right, so you deposited money in your bank account.
$2,000 a month is my first policy.
And then you started paying off debt. How long did it take you to pay it off?
All the debt, $984,711, was paid off in a total of 39 months, 3 years and 3 months. Now, not with just one policy.
Okay, how many policies?
I bought more policies along the way. I can't tell you exactly what month I bought each policy, but I started my first one for $2,000 a month. Then 4 or 5 months later, another one for $2,000. Then one for $4,000. Then another one for $4,000. And then I said, well, hey, if I pay these annually, it's even a little better. So now I was able to pay the premium annually instead of monthly. And because in the beginning, on my first policy, $2,000 a month, I couldn't afford to pay it annually.
Right.
I didn't have the $24,000 to pay it.
Right.
So then,
but you started freeing up cash flow that you started paying things off.
Exactly. And then after I paid somebody off, after I paid off a creditor, they were totally wiped out. I would pay myself back the same amount I was paying that creditor.
Right.
So I wasn't changing my cash flow. I wasn't working any harder, taking any additional risk or losing control. I was just changing who got the money. You have to be disciplined in order to do it, right? Some people aren't disciplined with money. Some people actually think because they have checks left, there's still money in the bank.
All right. So let me ask you a quick question. We got to wrap up. What's your wife think about the deal now that you guys are out of the debt?
Yeah, she gave me a hard time in the beginning, and now she's like, honey, I think we could buy more policies. I think we can do more.
I love it. Thank you, Brent.
All right.
That was awesome.
Thank you.
Tim, you're all the way from PA down to Alabama.
I think I'm the only guy above the Mason-Dixon line.
Is that right? I don't know. We've had some Canadians
We got some
here.
folks.
I was for a long time.
Because you're one of the original people that would come down to the think tank, right?
Yeah. I think I was one of the, if I wasn't the first, I was one of the first that ever had Nelson up for a client seminar.
That's really cool. All right.
1997.
So Tim, we would love to hear, because you go way back. You've on an insurance policy. How long ago did you buy your first whole life insurance policy?
Well, my first one was a policy my dad bought for me when I was 15. So
Wow,
it was just
that's
a $5,000.
Like 10 years ago? 15 years ago?
Something like that. But I still have that policy. There's about $4,000 of cash value, and every 3 years when I buy a computer, I borrow $1,500 against that policy, and
That's awesome.
that's my computer policy.
All right, so that
Nice.
policy was bought in what year?
So 42 years ago.
I was hoping you were going to say 19
Do the
before
math.
it.
So,
Yeah, well, I mean, not everybody's watching.
1979.
Yeah, there's a lot of people listening. That's older than.
1977.
Oh, wow. That's what a
Older
good
than
year
us,
that is.
Both of us.
That's a good year, 1977. Fine wine that 1977 was. All right, so Tim, your first policy, you're 15 years old, you're still using it. That's pretty cool. So clearly, that's not the one you bought. You wouldn't do anything differently there. The first one you bought was in what year?
1986.
1986. Wow, that's a long time. All right, so if you could go back and do one thing differently based upon what you know now through all your years of wisdom, what would be the change you'd make?
I would have bought less face amount and put paid up additions rider on.
All right, so explain that in case someone's listening that doesn't know what that term means, face amount and
So-
paid up additions rider.
I bought that policy for death benefit
Okay,
rather than cash accumulation.
okay.
So if knowing what I know now, I would have overfunded the policy, put more money than the premium called for, than the insurance company called for through what's called a paid up additions rider.
So you could have built up more cash. At the time, you thought you were interested in a death benefit. Now you're more interested in the cash.
Correct.
Gotcha. All right. No, that's good information.
All right. So, secondly, we know that you are sharing this message with all sorts of people up in PA and around the world, I'm sure. Tell us one thing, the coolest thing, unique thing, outside of the box thing people have done, either your client or you, with a policy that we can all learn from.
Well, it's interesting that about 3 or 4 weeks ago, I made a presentation to a gentleman who's an architect. And after I put everything together, he said, well, let me summarize what you said. And he's very analytical. And we have this idea paint where you can paint on the walls and just erase it. It's pretty cool. And so we did the idea paint. He said, he basically drew a diagram of, he drew a box with an arrow going in, and he said, so you want me to put money inside a life insurance policy. And then we were helping him with college planning, and he has 3 children. And he said, so when the cash builds up, I could take money out through a loan and then put the money back in through loan repayments. and then take it out for my second child and put it back in, and then take it out for my third child and put it back in. And then when I retire, my wife and I retire, I can take money out and that'll be tax-free. I said, yeah. So he diagrammed that on our wall, and it was so beautiful because, I've been doing this since 1997, and I never explained it that way or understood it that way. And the way, my clients teach me something almost every day.
That's cool.
And that's an amazing thing about it.
That's awesome. Can you think of anything that somebody has specifically used their policy for outside of, like, obviously he's going to use it for college planning, but maybe anything other than that you can think of?
Well, lots of things, Joey. So there's, I have a good friend who used the policy he loaned money to his high school buddy to start a business. And it was $25,000. And his friend paid him back in 3 years at 8% interest. This is probably going back to the early 90s. So 8% was a pretty fair rate of return. But he got all his money back. And for that, his friend gave him 12% of the business. And they ended up selling to a larger entity. And his share of the 12% of the business was about $1.7 million. So
that's
winner.
That's not bad on 25K right there.
Yeah. So think about this. In like 3 years, he got all his money back. Over the years, he got health insurance, a cell phone, several distributions. They spun off. They started another company and spun that off and sold that for, I don't know, he might have got about $150,000 on that. And then ultimately they sold the business and he got $1.7 million. So I think the biggest thing that taught me was infinite banking is more than the numbers that you see on the illustration on your policy. And that's the thing that people don't get because they're not hearing that message from the mainstream conventional wisdom Wall Street types.
Yeah, that's where opportunities find cash.
Yes.
And that's the unseen behind it. That is a very cool story. Thank you, Tim Urich, for being on the podcast.
It was my pleasure.
Welcome into the Wealth Without Wall Street podcast, Anthony Faso from Las Vegas.
I'm glad to be here. It's about time that you guys invited me on the podcast, to be honest.
Pretty famous now for is IBC a scam from a CPA's perspective. I thought that was a good,
powerful,
good podcast or good video there.
Thank you.
All right. Question is, if you could go back and do one thing differently from when you bought your first policy, which I want you to tell us how long ago that was, what would you do differently based upon what you know now?
Great. I got my first policy in 2010. And I read the book and I got hooked. I seriously could not sleep for the next few nights. And being a CPA, I knew a lot of typical financial planners. So I was taking this to them. Tell me why this wouldn't work. And they would give me a reason, and then I'd take it to my mentor, and he would explain it. And I could not find a hole in this. So I thought that I would try it. And I actually, even being a CPA, I saw what had happened to devastation in the last financial crisis. And I did not want that to happen to me again. So I wanted to take all of the money out of my qualified plans and put it into a policy. But I am married, and I want to stay happily married.
We're seeing a theme in this, by the way. The spouses have influence into these crazy decisions that we were wanting to make.
Look, I have an amazing marriage, and I love my wife, and we've delegated different responsibilities, and mine is more on the financial end. And she was okay with, she trusted me with whatever I wanted to do. But this was such a big decision, I didn't feel comfortable moving all of our qualified money out. So I only moved half. Because, well, actually, let me step back. I wanted her to read the book.
Okay.
She is not a reader.
Yeah.
Busy with kids and managing the household and trying to reel me in. She didn't want to read it. So I didn't feel comfortable moving all the money. I only moved half. And then finally, I actually had to trick her. I don't even know if I told you guys this story. I came back from an IBC seminar, and they said, this book is so powerful that don't give it away. You need to sell it.
Okay.
They were referring to my clients because if somebody pays for it, that now they have some skin in the game and they're going to read it.
Right.
Sure.
Right. So I said, if it works for clients, it should work with my wife. So I asked her for $20 because that's just how I roll. I asked my wife for money. And she goes, sure.
Because that's who holds it.
Yeah, here it is. But of course she asked, well, what is it for? And I said, it's for this book. I want you to read it. And she's like, oh, okay, all right. So I actually tricked her into reading the book.
She read it.
And she read it. And you know what her response is? How come we only put half of our money into the policy?
Come on, man. How'd you mess that up?
I know. So my thing looking back, I would have been more diligent. It's important for both spouses to be on the same page. So I should have made a more conscious effort to let her know how important this was. Or maybe I even could have read it to her at night.
Yeah.
Like how romantic.
Like sweet,
right?
the sweet
Reading
nothings.
Becoming Your Own banker.
Yeah, that is
right?
Telling her sweet nothings.
What
in her
not
ear.
to do. I mean, I love what we do. I love my wife, Megan. I know you're not listening to this because it's just you trust me, and
That's right.
And I know that if I was reading you this book at night, you would punch me in the face. All right.
So, Basso, tell me this: something that you have either seen a client use infinite banking for that was unique, or maybe yourself, something outside of the box, something we can learn from.
Perfect. I'm going to give you two examples. Then you guys can edit out the which one. I will say, and I had two policies on my kids, and with my daughter, I tell you, I only thought of it as just of a way to finance her education.
Sure.
And then teach her about IBC and that she could use it when she got out of school. Little did I know a lot of the other benefits of it. My daughter, as you guys know, she had brain surgery in 2012.
Wow. Yeah.
And it's been a blessing. Unfortunately, she got through it and is doing fine. But you know what? I tried to get her a policy last year because she turned 18, and she could not qualify.
Right.
Even though it's been over 5 years, now I've kind of realized, looking back, I wish I would have gotten more. I only focus on the cash, on the cash value, but there's so many other benefits with this amazing tool that we have. So I just want to make that a point out there that this is not just about cash. There's so many other things and so many other important things that this tool that we have can help.
Right.
Now, with my son, he's 25. So now we're getting to the fun part where he is out of school and we finance his school with policy loans.
Right.
So now we're going, when he graduated, and you guys may have seen this picture on Instagram, that I gave him, I gave him a nice watch and the book by Nelson Nash, Becoming Your Own Banker. And I had him read it, and I taught him, and he had some great questions. And now I'm going through the process of teaching him how to use it. Now that he is in the workforce, I said, hey, instead of funding an IRA or 401k, why don't you take over the premiums?
Yeah.
And then the other people you are working side by side with that are paying back their student loans, well, why don't you pay off these policy loans? So now we're setting him up, and he is learning how to use this. And we are in the process. He's into computers. We're actually had flipped a computer before. So we actually use his vault to pay for the pieces of the equipment for the computer. It was for mining. We just hit the right sweet spot. Yeah. We bought a computer for like $1,500, and then we sold it for $4,500.
Yeah.
But we had helped finance that by using this policy.
Where were you at when we were buying mining computers for $5,500?
I could have caught you a deal.
Sore subject.
So now he not only has used the money to finance his education, but you've given him an outlet that his friends are equally doing. They're saving money in IRAs or 401ks. They're paying back college loans. And you're showing him how he's building equity in something that now I'm assuming you're going to give him access to borrow against down the road.
Sure. And really just kind of the way we're rolling, he has to prove that he can use it. He has to prove that he can pay the premiums and he's not going to steal the peas. Yeah. And I'm very confident that he will. And when he does that, I'm going to give him a policy that's going to be maybe 12, 14 years old. That is just screaming cash.
That's a huge gift.
What a cool thing. Thank you, Anthony Faso, for being on the podcast.
My pleasure. Thank you, guys.
Welcome into the Wealth Without Wall Street podcast. Chris Gardner from Dallas. What's one of the investments that you're talking about?
Yeah, give an example. Just one of the stories that your clients came back and said, hey, Chris, I borrowed money. I went and did this with it. And you were like, wow, that's pretty cool. I didn't think about this. I mean, here's an example for this. Because can I step in his shoes? Give Chris just a second to think about it?
Sure. Just take over. This is how you do it.
This is your podcast.
Well, this is a chance for me to talk. I've been asking all these questions. I feel like it's my chance to talk this time.
You can't cage them up.
The coolest question as I knock over the mic for the Facebook Live video. The coolest thing that I ever saw one of my clients do, and maybe more innovative. I had a client that, in all intents and purposes, was not that creative. I mean, if you looked at the guy's outfit, you'd say, yeah, I mean, this guy needs some help. But when it came to intellectual creativity, this guy was in a league of his own. He came to me one time, Chris, and he says, Russ, here's what I want to do. I've got a 401k that I got $100,000 in. I can't touch it. I want to touch it, but I can't. There's nothing I can do. I want to put this money into a life insurance policy, but my company says I can't take it out because I'm still working here. But what I figured out is I could take an actual 401k loan, and I want to start a policy, and I want to put that money in this policy, and I'm going to do this over and over again, and I'm going to repay the 401k loan, and I'm going to keep taking the money out and stick it in this policy, and eventually I'm going to leave this job. When I do, I'm going to take all that, and I'm going to pay back the loan at the insurance company. And I thought, that may be the coolest thing I've ever heard in my life.
That guy's probably genius level.
He is. I mean, he's literally like one of the cooler
Mensa, right?
people I've ever met. You're looking at Joey, the Italian stallion. That was his idea.
Hey, that's funny you say that because I've actually got one of those. As a matter of fact, that happened with my dad's policy.
Really?
So, long-time worker, Peterbilt Motors, building trucks, right? 401k, that's all he's done, right? Had this big 401ks built up. But yet, had a lot of things paid off, but no cash, right? And so all of his money has always been taught was put the money in the 401k. And sure enough, that's how he started his policies off. Did the same thing.
Really?
This was several years ago. And, he's been able to build multiple policies by doing that. Yeah. And it was his money anyways, right? Yeah. And the money he paid back, it went back to his policy or his 401k, and then he gets to redo it again. So that is a cool story. So great story. Mine, I don't know how exciting it is, but I will tell you why this is a cool story. Client of mine is entrepreneur who has restaurants, who has car washes, who has real estate, things like that, right? One of the coolest things that I remember getting a call from, we talked about becoming your own banker, right? Doing the thing right. Well, he has all these loans out because he says he's franchised, he's restaurants, and he's real estate. And, he's collecting rent and all this stuff from these properties that he owns. Well, what he started doing was, as simple as it sounds, was he just started taking out loans from his cash, started building more policies after more policies, and then he started paying off his notes with his rental properties. And so he kept doing this over and over and over again. And what happened was he got a letter one day from the bank that he does all this business with, and he says, "What in the world are you doing?" I got a letter. He literally sent me the letter, and the letter said,
the bank didn't want their money back.
No. They were like, "Why are you paying us off? Like, what are you doing?
This is not what people do."
No, why are you paying off all these loans? Like, we don't understand. Would you quit doing this? Basically, what the letter said. I wish I had it to this day. I have a copy of it. And he's like, I'm just trying to get some of what you guys are doing. And that's what he told him. And so these guys make more money financing their own rental properties than the rent that they collect just on that. So now they are the bank on all the rental properties, and they make way more money doing that.
Oh, that's beautiful.
Such a great story. Chris, this was your first time. You did an awesome job. You need to do it again. We appreciate you sharing. Great stuff.
Appreciate you having me, guys.
Welcome back into the Wealth Without Wall Street podcast, Caleb Williams.
Congrats on that, by the way.
Thank you.
We love the fact that at 22 years old, you're changing people's lives, and it's just amazing to hear the things that are going on. But we want to hear a little bit about you right now. We want to dig into when you bought your first policy,
right?
And if you would do anything differently, what would that be?
So the quick backstory on buying my first policy is, discovering this was an incredibly frustrating process.
Yeah.
And at the age of 19, I created my policy for myself. So I had no idea what I was doing. I was just working with this company. It was a mutual company. And, I put what I thought was a lot of money at the time. I put $400 a month for a 19-year-old.
That's a ton of money, bro.
Right. And knowing what I know now, I wish I would have put more. But my aha moment happened when I went to Guatemala. Yeah. I was going to Guatemala, and I realized I would use my policy to fund this mission trip. And the aha moment was I was on the plane, and I'm like, my money's still growing. And that's when I knew I had to start another one. But I don't know if I would change a ton other than I wish I would have put more money in.
Well, that's the common thing. So I want to, since we've been asking everybody, when did you start the second policy? How long after the first one? How long did it take you before you started your second one?
1 year.
1 year. All right. See, it's very similar. 6 months, 1 year. 19, man. God, can you imagine?
What if you had started yours when you were 19?
Dude, I'd be sitting somewhere else right now, maybe. I don't know. All the success I would have had if I would have learned about this thing.
Wait a minute.
That long ago, man. Yeah, I'd be like phoning into this. This would be like phone a friend. You would be talking to me elsewhere.
Hey, I want to do a shout out to Jacob Williams, my friend Jenny Williams' son, who hopefully she's going to be on the podcast soon. She's got her son to start a policy when he was 19.
Right.
And so you guys are living right alongside each other.
What's really awesome. Cool is I have 3 clients who actually their grandparents funded policies, and the youngest is 2 years old. And it's so cool to see the impact that this is going to have, not just to pay for college, but it's going to have a legacy for that kid's grandchildren. And that's just going to be amazing.
That's huge.
That's pretty cool.
All right. So you fielded our first question well. Okay. Congratulations. Second question, what is the coolest outside of the box, some would say uniquest.
Right.
They would be incorrect, but uniquest thing that they have ever seen you've seen a client use their policy for, or you personally use your policy for?
Okay. I'm going to just because this is who I am, I'm going to give 2. So you can edit out 1 if it's bad.
2 for 1. Okay.
The first one's actually pretty touching. One of my first clients, Greg Helema, used his policy to actually purchase cows. He flipped cows, mini cows.
We love cows here.
Well, and in the South, they flip cows. They flip cows for fun.
Right. No. This is like he bought mini cows. They would name them. I think they were like they would name them. They would like pet them down, and then they would slaughter them. And the cool thing was.
I'm sorry. Hold on. Did you say mini cows?
Like mini, like they were miniature cars. Miniature cows.
Like mini me?
Like dwarfs?
Like they were small cows.
Small cows. Is there? Yeah. Hey,
is that a thing? Am I being punked right now?
No. This is for real.
It's a political correct term for mini. You can't say dwarf. I don't think that's appropriate.
All right. Well, okay. I'm gonna just have to Google that after this. Okay, go ahead.
Okay.
Continue. I'm sorry.
Stallion.
Oh, sorry. Back. We got sidetracked. Squirrel.
I mean, we have full-size cows. Okay,
that's right.
But the reality is this: the access to capital gave their whole family the ability to purchase 3 miniature cows, Joey, and then they flipped them, and they would literally make hundreds of % on their dollar, and it would give them fresh meat. let's go into flipping again.
Hold on, though. You can flip a miniature cow a lot easier than a full-size cow.
Right. But when I say flip, I actually mean like process, like kill the cow.
Kill the cow, turn it into meat, and they were making hundreds of % in addition to eating mini hamburgers.
In addition to eating.
Is that where sliders come from?
Is that where they get the Crystal Burger from?
Right. But do you want a mood killer? This same client got diagnosed with stage 4 cancer.
Ooh.
So, but here's the crazy, overall like picture, and it really, really hit me, aha moment, is we gave this family in like an incredible access to capital throughout their 4 years of having it. This guy, Greg, got the best health rating. Okay. Family, and then when he got diagnosed, and it's only a matter of time, I had an opportunity to sit down with him, and we went through all of what his kids is going to have and what his wife's going to have. And what the cool thing is, even though he's one of my best friends and it's heartbreaking, it's like, it's a perfect example of what we get to do. It helped him today, and it would have been amazing if, he retired, but it ultimately is going to take care of his family. And like, that's, again, it's power. That's where it was like, holy cow. And I'm young. I wish I didn't have this example.
That's changing lives.
Yeah.
That is crazy. Now I feel bad about all the jokes about the cows.
Yeah, come on. But I will say that is like one of the winners, like using it to flip miniature cows. That is the most unique.
But think about what he said, though. The fact that he bought a policy, got the highest rating, and less than 4 years later is diagnosed with stage 4 cancer. And somebody earlier said that it's not just about the cash. And sometimes we get hung up on the cash, and we start trying to figure out how quickly can our cash value equal what we've put in it, and we're so hung up on that miniature part of it. Not a pun on the mini cows. I'm sorry. I know that's going to happen.
You got me on that one. I'm sorry.
But he literally has now. I mean that's huge.
Yeah.
God, that's a really nice story. I appreciate that. You said there was a second one.
Yeah.
What's the second one?
The second one is I have a 19-year-old kid who's crushing it on the e-commerce world. E-commerce, for those who don't know what e-commerce is.
Tell this for Joey. Break this down for Joey, okay?
Is buying and selling online, and this guy is killing it on Amazon. He's making hundreds of thousands of dollars selling on Amazon, and he actually teaches others to do the same. And he, at 19 years old, put it 6 figures into life insurance this year, and used his policy in year 1 to start investing in capital. And I just that was a big win for me, because how many people are putting 6 figures into life insurance
to begin with?
And this kid he understands how to utilize that capital to be very ROI positive. So he would actually be a great guest for you guys to interview sometime on your show.
Wow. Right. So 19. He kind of one upped you. You kind of looking back on that 400. You're like, so he's putting hundreds of thousands in, and you put in hundreds of dollars. That's pretty awesome, man. Right. Very cool. Well, Caleb, you're crushing it. Thank you for what you're doing. I know the Helema family is going to be forever indebted to what you were able to help Greg do. Thank you for sharing that story. Thank you, as always, for being on the podcast.
Guys, thank you for having me.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.